Welcome back to the Compass. As we enjoy this bull market, which we'll talk more about. With me, as always, is Sam Pelaez, President, CEO, and CIO of Olive Resource Capital. And my name is Derek Macpherson. I'm the Executive Chairman. First thing to talk about today is all of September results. I think it leads into kind of our discussion for today. But Olive had an exceptional month and is doing really well year to date. Sam, why don't you break it down for the viewers?
Yeah, so I don't have all the monthly numbers in front of me, but I dare to say this is our best month. We were up somewhere between 38 and 39% for the month, quite exceptional by any measure. And that obviously on the back of quite good results in Q1 and Q2. That's propelled us to being up more than 100% year to date.
It's 121% in case people are keeping score.
So we've had excellent results. We've been able to participate on this bull run. We've had a number of winners, and it's awesome. I mean, how else can I put it?
We spent 4 years rebuilding Olive to being ready for this sort of moment. And there's a lot of blood, sweat, and tears in that, and the result is what we're seeing. We're well positioned. We've built a portfolio that's well positioned to take advantage of what is clearly the early innings of a bull market. We're already seeing exceptional performance. But being up almost 40% in September, as much as I would love to say that is all of our stock picking and expertise, and that we're exceptional at what we do, which I do think we are. I am completely biased when I say that out loud. The unique thing is we were able to take advantage of the market. And I think September in and of itself was a ridiculous month overall for commodities and commodity stocks.
Yeah, for one, gold is obviously the biggest outperformer this year. I'd like to remind people that we are not a gold investment product. On any given time, we have about half of our assets in precious metals. That also includes PGMs. But we've been able to deliver gold-like returns. And that obviously is testament of the outperformance of our portfolio. But going to your point on the September numbers, we were up nearly 40%. Just for reference, the GDX, which is the largest kind of gold investment product out there, the ETF, that was up 20% in US dollars. And the COPX, which is sort of the equivalent for the copper industry, was also up 20%. So on a pure relative benchmarking, whichever way we look at it, we had a quite spectacular month by any measure, and we're very happy with it.
For us, it's vindication or vindication of what we've been doing the last 4 years. When we first sort of took this vehicle over and then had to spend a lot of time fixing it to turn it into what it is today, there were a lot of naysayers, if you will, and few supporters. And so I think our ability to deliver here is certainly reassuring by a stretch of the imagination. But
sorry,
but I
was just going to continue talking about the markets themselves. Obviously, it's awesome that we take a victory lap. I think myself it's deserved, but I think there's the underlying tailwind of the sector and the money flows into the sector that's obviously been the crucial catalyst to enable us to deliver these returns. And I think it's important to talk about that in itself more in a macro way. And the months of August and September, both consecutively, have had the equities, particularly gold, but also in other commodities, significantly, and when I say significantly, is multiple-fold outperformed the commodity. So gold equities have been roughly 20% up on each month, August and September. The commodity has been up somewhere between 5 and 7% in each of those months. So you're talking about a typically 4x outperformance of the equities to the commodity. That only happens when there's fresh money coming into the space. There's no other way where that can happen. That's generalist money and money that's on the fringes coming directly to participate into the industry and buying up these equities.
Well, I think the other thing that's key there on the generalist money coming in, and we'll talk a little bit about the importance of that outperformance, but before, the other key thing on generalist money coming in is there was almost $1 billion in cap. There was over $1 billion in capital raised last week for the primarily into pre-production equities. That's the kind of capital that some of those are builds, some of those are world-class assets. It's across the board, but that is real money, for lack of a better description, and that's money that is whenever you see, and this has been my experience over the years, back when I was an investment banker and a research analyst working on the sell side, whenever you see a 9-figure financing, it means generalist money is coming in. So if it's north of $100 million, there is money from outside the sector that has to be invested here coming in. And I think that's always a good sign, because this is a capital intensive business.
Yeah, I mean, we're very happy that we needed to get to that hurdle sooner than later. It seems that we've reached that point. I'm starting to see, and I'm sure the audience is also seeing, more references to mining and gold under the channels where the gold market was completely absent, the investing channels, etc. Some of the people that have been absent from the space and were promoting other industries have come back. That's a sign that we've moved from this kind of like first stage in the cycle of the early recovery to a more sort of like the beginning of the intermediate phase, I would call it. We still don't have the crazy ideas that come in the later stages of the cycle, but I like to know where you think we are, because in my view, this is sort of like we're starting to move from the beginning of the cycle to the intermediate phase.
Yeah, I think we're still. I think we're still close to the beginning. We're just starting to see those inflows. I had it's certainly not my quote, but when you're in a commodity bull market, it's like trying to pour a bottle of scotch into a shot glass, right? And the scotch being the capital, right? There's so much capital coming into the space. It's why there ends up being 1,000 junior equities, right? Because there's capital that just gets thrown everywhere. And then the consequence of that is that you get a lot of wasted capital, right? You get you stick capital into companies that shouldn't have it. That capital is wasted. They're not ready to drill. They drill anyways. It becomes it's like, I don't think we're seeing that. I think the companies that are really outperforming, companies that are doing well, are the ones that are, and the companies that are attracting capital are ones that have real projects. They've done the work. They're moving things ahead. They're producing quality catalysts. I think that is so I think, we're still early. Maybe we're, I don't know if it was a baseball game. It is Major League Baseball playoffs here in North America. So, and the Jays are doing well. So, we'll use that analogy, but, we're not in the first inning, but we're not in the fifth, right? We're kind of, maybe we're in the third inning of this cycle. And it's not linear either, right? We could be here for a while. We can have step backs, move forward. We could accelerate quickly to the end, right? We're at a point where gold's flirting with $4,000, and with no real, as of this morning, it was below 4,000. Just for the record, by the time this comes out, it might be through. But gold's flirting with 4,000, and so I think, and there isn't a real, for lack of a better description, there aren't obvious things that are going to materially slow the gold price down, right? I mean, obviously we've got some political risks that can come out if we get peace in the Middle East, which, I think for 2,000 years that's been impossible to achieve. So maybe this year, but maybe not. Between Ukraine and Russia, what's going on there? Again, peace there could take some of the political risk premium out. But I think what's driving gold really is central bank buying in the weakening U.S. dollar, and the two of those things are hand in hand related. But I want to go back to something before we get really deep into where we are in the bull market and what we should do. We talked about one of the things you talked about in September, which drove our portfolio performance, but it drove everybody. Everyone's stocks were up on this. It was that the equities outperforming the commodities on the upside, and that is, when we were preparing for this episode, we talked about it. But I think a huge piece of that is that the market is implying that the commodity move is permanent because they're impugning the excess profits. They're pointing the excess profits into the portfolio, into those companies. So they're not assuming cost inflation, and they're assuming that there is that extra profitability from the commodity price rise ends up going to the bottom line of those companies.
There's precedent for this. If you study the cycles, when the commodities lead the equities, sorry, when the equities lead the commodities, I got that backwards. When the equities lead the commodity, it points to a more sustainable bull run rather than the other way around. When the commodity leads, it's typically because of a supply element. It's not as sustainable, not as longer dated. This implies that we still have quite a bit of runway ahead of us for both the equity and the commodity to continue running. So it's very encouraging for market participants that this is the case.
I think another point, and it just occurred to me as we're chatting, and we keep talking about commodities. We don't talk about gold. I think that's a really key point. Is that yes, gold is leading right now, and has been the commodity that's outperformed, and those equities have relatively been outperforming. But you raised the point, right? The GDX was up 20% last month. So was the COPX, right? Which is the copper ETF. And so I think a key point is that typically in a commodity bull run, if you look back at the last couple, the fundamentals that drive gold higher ultimately benefit all sort of hard assets, including other commodities like copper, platinum, palladium, etc. And you get that, after following gold, you get gold, probably silver second, when we've seen a big move in silver, and then you get sort of some of the other more industrial commodities also have a big move.
Yeah, even zinc is waking up, which is the most sluggish of the LME metals. But I think ultimately, I think it is our view, and I want to say this collectively, that we're certainly past the beginning. Companies like Agnico have come from $30 a share to over $130 a share. Obviously, there's been big moves. But by no means does that imply that we are approaching the end or anything of that nature. We still remain of the view that there's a lot more to come here. We've positioned the portfolio to benefit from what we think is coming next. We've just had this past month some realization of some of those objectives. But by no measure do I think that it's time to step off. Step off the trades, step off the macro. Close the positions. I think the fall seasonal period is typically weak, and there is a chance after this, exuberant months that we get some sort of consolidation or even a small correction. But this is all part of the underlying positive trend, and the medium to long term still looks extremely favorable to me.
I think that's an excellent point, right? We're in the early innings of the bull market. There's lots of room to go. Typically, after we have a period of heavy capital raising, which we've just gone through, basically August and September have been very, very heavy capital raising months. There will be more raised, but at some point that will wane a bit. Everyone who wanted to get in will be positioned, and then so you'll get a bit of a softening, right, as people figure out what they bought and you got to keep in mind, right, when one of these, I don't think a lot of generalists quite grasp this, right? If a deal goes up, you get a call. So we get a call at 4:00 on the day that the deal's announced and asking whether we are going to participate or not. And for us, we run a pretty concentrated portfolio. We're pretty disciplined about not throwing money at things we don't know. But for some investors, if you have a lot of money to deploy in the space or you're cash heavy, you kind of have to. You have to react to that, and especially if it's a larger name. And so the other advantage that we have is that we can, we could even after all this outperformance and being up to $14 million in assets, we could still build a position in the market effectively. We don't need a financing to build a position. Whereas for some of these other larger funds, et cetera, they have to. And so they have to react. And so, and a lot of these financings are life with the warrant. I mean, there's some good, better companies that are able to do it without. And so you have these people are collecting all this stuff and they figure out what they own after, right? Well, what do I own? What does it look like? What are the catalysts? Oh, I don't like that. I'm going to trim here. I'm going to, right? And so after you get this period of capital raising, you tend to get a lull. Couple that with a period of potentially being seasonally weak, although the Fed cutting rates and being more dovish than it's been in a very long time certainly doesn't bode well for that pullback. Everyone's expecting a pullback. That is always the thesis. It probably doesn't happen. That's kind of a key point, is that you're going to see this lull. Even if there is a lull, it doesn't mean stocks are going to sell off or that there's going to be material weakness. It probably just means there's going to be a little bit of pullback, whether it's 5-10% across the board, which isn't the end of the world by any stretch of the imagination. It certainly doesn't change our thesis on where we are in the bull market. It's a softening. And I think that's the opportunity. What we're doing with our capital is we've been trimming on the edges, right? We have a lot of positions that are up massively, 300% this year. You don't get 120% outperformance without having a few positions like that. And generally what we're doing, not in every case, depending on the position and what we think of the fundamentals, we've been trimming on the edges and raising a little bit of cash and having ourselves positioned for new opportunities to get back into things, etc. And so this creates opportunity there. But I think this is a point, Sam, we wanted to talk about here, because it's something that everyone's looking at their portfolio, right, including us, and you go, I own company X. They put out really good drill results last week, and we own a couple of them. And the stock is up 200-300%. What do I do now?
Yeah, typically when you've been invested for years in an exploration story and then it's successful, the knee-jerk reaction is to immediately sell. You're up 3, 4, 5-fold, sometimes 10-fold, and the immediate reaction is to sell. And that's not always the best strategy. And it's a skill that you develop over time, which is, how to reassess and reevaluate the story and the investment with the new information that's available to you. And I venture to say that some of the stocks that we've talked about recently on this podcast that are up multiple times on the back of specific results may be even cheaper today based on the new results than they were prior to the results. And what I'm trying to say with that is that, I'm more compelled to buy more today than I was before the results in some cases. So you need to adjust the thinking, not just as you move through this innings, like you call them, or the parts of the cycle where the commodity price references are moving, but you also need to be able to adjust your thinking to the news releases and the discoveries, in this case, of the companies that you're evaluating. And whereas there is always the possibility that things run ahead of themselves and check back, in many cases the check back is the opportunity to reload or increase your position weighting to the company instead of selling out of fear. And I want to point to one of our most talked about companies from the past, which is Great Bear, which thankfully, because it's no longer around and we can look at it in hindsight, we can use it as an example many times over and over. But it was at one point it was $1 stock, at one point it was 5, check back, then it was 10, then check back, then it was 15, then check back. I think the guys actually at one point said that the stock was down over 50% 4 different times. It was more than 50% off the previous highs. But ultimately, it got taken out at $20 or $29 a share. And that was not in a bull market, to add to the whole concept. That we were not adjusting also to higher commodity prices in that case, like we have to do today. So I guess what I'm trying to, just to wrap up the thought, is you have to readjust your thinking every single time now as we move from one stage to the other, and also as you get the company results, because you may be staring at companies that are actually cheaper now on a relative basis compared to what they own and the commodity price we live in, relative to when you actually decided to buy them as bargains months or years ago.
That a stock is up 300% and is cheaper is the quote of the day, I think. But I think that's a really good point. Our natural reaction is to stick with our bias, and that is a big challenge, right? Something that I struggle with, and we struggle with, and I think probably all investors struggle with, is that your natural bias is to think of the story the way it was. Even, so on a position, we're up 300%. We're looking at it and we go, well, that's cheap now. To make that connection of, oh, it's up 300% and that's cheap, is you have to look at it, reevaluate what you own, and then decide what's going to happen. The same thing happens for stories you don't own. One thing I noticed today as I was reading through the news, the headlines, there was a lot of news today and a lot of drill results. Now, we're into the period where the seasonal explorers, the typical summer seasonal explorers, are putting out news. And so you're seeing that the result of that is that you get increased news flow. But I think that what you were seeing, though, is the consequence of having more capital. We're going through a period where there's a lot of capital being raised, August and September. But we went through a period in the spring where a lot of capital got raised as well, right? It wasn't just, and so we're seeing the result of that. Capital gets raised, then you get results. And so the key, I guess, the point that I'm getting to in a very long-winded way is that companies are changing. The result of capital being injected, the result of them, if they're deploying it effectively, the stories should be changing, right? Whether that's, they're closer to a maiden resource, they're putting out a maiden resource, they're putting out a PEA, they're doing additional metallurgy, they're a target, credit to Prospector Metals, which is a company that we've got in our portfolio. They went and did all the cheap work in the bear market, right? They acquired the asset, they did all the cheap work in the bear market, and now they are benefiting from that. Now they're able to go, now they have capital and their cost of capital came down, they went and drilled some holes, and bang, you've got you have a success. I think that's part of the thing that everyone needs to set their minds to, is that just because you know a story doesn't mean you know a story anymore. And because things are changing, and you have to be constantly aware of that. And so I think that's something that, that doesn't mean that you take away your filters for management or balance sheet or ability to raise capital or any of those things. But your projects are going to change, companies are going to change. And so it should change your bias as how you approach it.
And this happens across the entire spectrum of companies. When we got invested into K92 at $6 a share, I remember thinking to myself, this is a $15 stock and we're out. And today is an $18 stock. But the gold price has doubled. The entire relative benchmarking that you compare them against, it's up 150%. So technically, they still don't have realized the value, the organic value that I think they're going to realize relative to the benchmark. And so it's no longer a $15 stock. Like, you have to constantly be readjusting your expectations based on the price and on the relative comparables. And I'm not going to tell you what our new my target price is now, because that'll be potential encouragement to invest, which this is not what we do in this podcast. But the constant readjustment and reimagining of the different stories in light of the new prices and the new context is a skill that you need to develop, and especially in the bull market, because it happens so fast and things change so quickly. And like you said, the news flow comes just like, this week has been incredible. Just the number of, and last week and this week has been incredible, the number of news items that we've received. Like, honestly, we're barely keeping our heads above water with all the other responsibilities, just trying to reassess all of this new information. I guess that's the encouragement out of this video. Is number one, don't get off the trade just because it's gone up before you get a chance to reassess the opportunity in light of the new information. And two, the skill that you need to develop in the bull market is exactly that. Drop the anchoring to the past and run your research again, as if from scratch. What are the comparables? What is the market pricing these things at? Based on these results, has it moved from this to potentially being something like this? And effectively, you have to do the work all over again.
I think that's the key, is to, although the I want to go back. So K92 up 200%, still cheap. Is the conclusion there. But also, yeah, those biases are what kill you. Though that inability to separate from those biases, because it makes you sell too early, or it makes you miss an opportunity that you probably should have been looking at and you should have been buying. And we miss all the time, right? It's not, you're going to miss, you as an investor are going to miss opportunities, right? You're going to be presented a story. Back to your Great Bear example, I had Chris Taylor in my office when he was doing the 15-cent financing, right? And at that point in that market, with what he had in hand, we couldn't help him. I wish I could have, because I would have made a lot of money. But that is we're all going to have you're going to have misses. That's okay. You can miss things, right? But maybe you see a drill result on a company that you haven't followed before and think, well, that's a really good hole. We should put that on the radar, pay attention to that company. And maybe it's up 100% that day or 50% that day. And you just wait. Like I think a spot where we're not adding just because of position size, but that I think is creating opportunity is, as an example of that is Sterling Metals, right? Sterling had a massive run on the day of that, the drill result last week, and is subsequently pulled back. It's still up 100% from where that drill result is. I would argue that it's pretty attractively valued here at this point for what they've drilled and defined, right? And so there is this. You can't just because you see a result and the stock's up, you can't write it off either, right? Because you might say, well, that's a really interesting result, and this stock could be different. Because you have to keep in mind, it's not just what has changed. What makes it a bull market is that company puts out good drill result. They're able now, because the stock goes up, their cost of capital comes down. They're able to raise more capital. They're able to advance it beyond that, right? Now, somewhere in that process where they're getting to the next stage, you might be able to pick up the stock cheaper than where that initial peak is, or maybe it does this and then has a little bit of a pullback and you missed it here, but you can get it here because you like where it's going. So I think those are, I guess, back to your point on the conclusion of this episode is, stay long.
Well, I think, we've been waiting, just like Olive, we've been working behind the scenes for years. Now we've been shoved by this amazing tailwind of commodity prices. Some of our investments have had their own amazing results. But we don't think this is anywhere near over. And some of the stories that have gone up 3, 4, 5-fold, we still think there's substantial value within them. So don't get off the trade just because it's up. That's I think that's the conclusion of the video for me.
Yeah, we've been waiting 15 years for a bull market. 200-300% on a position is not what you're here for. On a single position is not what we're here for. We're here for a much stronger run. So I'm gonna conclude this. This is not investment advice. You have to deal with your own personal professionals on that. Keep in mind position sizing and how much you own of things. We do that all the time, but the general theme is that you want to stay long and have exposure to this market because it's moving. Thank you very much. We'll see you next week.